In a political and macroeconomic environment, like what we're seeing now in mid-2025, it's a very smart idea to make sure to add safety into the portfolio, but not so much conservative safety like going completely cash or even bonds. Here are 6 of the safest stocks to buy and hold forever based on their consistent performance, strong financials, recession resilience, and dividend history as of June 2025. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Now that first stock on this list is Johnson & Johnson. And I'm sure that you've heard of it, but it's a diversified, resilient healthcare giant. It operates across pharmaceuticals, med tech, and now-minded consumer health risk across stable sectors. You likely use multiple Johnson & Johnson products each and every day. They've had some solid strategic growth moves acquiring intracellular therapies and investing $55 billion in US manufacturing over the next 4 years. They're continuing some mergers and acquisitions worth billions, broadening medtech reach. They're obviously in the healthcare sector. The dividend yield is around 3 to 3.2%. The years of dividend increases is 62. It has a payout ratio about 65%, and why it's safe is because it's highly diversified healthcare giant with stable earnings and consistent dividend growth. This is a true dividend king. As a reminder, this video is all about some solid, safe picks. You don't want your entire portfolio to be boom or bust, where it could possibly go crazy, but it could also come crashing down. You want to have a piece of the portfolio that's nice and stable, nice and consistent. So these stocks might be a little more boring, but I promise you it's not going to be boring to get a consistent paycheck or to make sure that your portfolio doesn't go falling straight down while the rest of your friends' portfolios go crashing down. Number 2, this next one has been paying a dividend for 135 consecutive years since its incorporation in 1890 and has increased its dividend for 69 consecutive years. You guessed it, this one is Procter Gamble. This is in the consumer staples sector. It has about a 2.5% dividend yield, and its payout ratio is about 60%. This one's a safe bet in your portfolio because it's a recession-resistant consumer products powerhouse. Its commitment to dividend growth is unmatched in its sector. Now, while Procter Gamble is a household name and has been around for quite some time, and so many dividend investors love it, there are some pros and some cons. So the pros are the defensive fundamentals, the diversified portfolio, a reliable dividend yield, strong cash returns, and proven brand strength. But the cons are specifically surrounding that tariff and execution risks, the consumer demand pressure, and at this point, it is at a premium valuation. So right now, it's one that has been a bit affected by the tariffs or the tariff situation since we don't have any idea of what's actually going to happen there. And so you need to look at this from a short-term lens and a long-term lens. Short-term, like in the next 6 to 12 months, the restructuring and tariff impact create uncertainty. Consider holding for stability and dividends, but avoid heavy new purchases until cost savings and price increases confirm their effectiveness. In the long term, like 3 to 5 years, if Procter & Gamble successfully executes its digital transformation and maintains brand leadership, its cash flow, low volatility, and dividend growth make it an attractive for conservative, income-focused portfolios. This next one's actually a high-powered growth stock, but also an amazing dividend stock as well. But first, thank you to Investing.com for being the sponsor of today's video. Investing.com is the go-to financial website many of us use daily. When you subscribe as a member, you get access to Proix. Proix uses artificial intelligence to analyze the market and gives you a list of the top investment opportunities. It saves me a ton of time. Instead of spending hours researching stocks, I can now check their picks and make informed decisions in minutes. One of my favorite tools is this Warren AI tool. For this video, I asked it which is better to invest in from those first 2 stocks, Johnson & Johnson or Procter & Gamble. And it gave me so much information, but right here you can see Johnson & Johnson offers more yield, value, and upside. I also really like the chart it built out and many different reasons to justify the answer, so I can research further on my own. As an Investing Pro member, you don't only get access to Pro Picks, but a whole suite of other powerful tools. For example, there's an ideas section where you can look into and copy the strategies of legendary investors like Warren Buffett. With my link, you get the lowest price of the year on an Investing Pro subscription. Click the link in the description to subscribe and start using Pro Picks today. This offer is only available for a limited time, so don't miss out. So number 3 on this list is that high-powered growth stock that's actually one of the top stocks in my entire personal portfolio. And this is Microsoft. And we all know what Microsoft is and what it does, but why should we invest in it, especially moving forward? Microsoft offers a compelling mix in 2025. It has dominance in cloud and AI with sustained double-digit revenue growth. It has strong cash generation with shareholder-friendly returns, a diversified business model reducing single-segment dependency, and continued trust via security focus and AI ethics initiatives. Microsoft's ideal for growth income investors seeking exposure to enterprise AI infrastructure while retaining blue chip stability. Microsoft is uniquely positioned to benefit from enterprise digital transformation, AI adoption, and cloud expansion, on track to remain a top-tier Mag 7 powerhouse. The sector is obviously technology. It has a dividend yield of 0.8%. It's had 21 years of dividend increases, and the payout ratio is about 28%. The reason why this one's safe is that while it's not a high-yield dividend stock, Microsoft offers strong dividend growth potential thanks to high profitability and low payout. When I asked Warren AI from Investing.com why or why not to invest in Microsoft, I love the response. Microsoft is a fortress with momentum, but also a stock where optimism is richly priced in. If you're seeking growth with blue chip stability, it's a top contender. Just know you're buying the penthouse, not the fixer-upper. It's not a stock that's going to shoot off to the moon from here, but it will be very stable and very safe, which is what we're looking for, and it's probably going to be the only one that I could say in the technology sector that I think is actually a safe and solid bet. Number 4, Visa is just one of the most stable bets for an investor. I mean, if we look at the chart here, it does have the normal dips, but overall that thing is pretty up and to the right all the way. It's in the payments or fintech sector. The dividend yield is 0.6 to 0.7%. It's had 16 years of dividend increases. The payout ratio is at only 20%, and that's very safe because a low payout ratio leaves lots of room for future dividend increases. The high margin, the global business with secular growth tailwinds all make it a very safe bet. Now obviously with this one there are pros and cons. The pros of Visa is the durable double-digit growth, the hefty capital returns, leadership in digital payments, and strong innovation and analyst support. The cons though is that it is sensitive to economic cycles, the regulatory risks, and does have premium valuation right now. This one is ideal for investors seeking a blend of growth, dividend income, and conviction in long-term fintech themes. Number 5 is one of Warren Buffett's favorite companies, and Warren Buffett seems to know a little bit about investing, and very much about dividend investing and picking something that's just long-term, safe for the portfolio, and gives you a very solid payout. His investment currently in this company comes out to roughly $2,235,616 in dividend income per day, $93,000 in dividend income per hour, $1,500 in dividend income for Berkshire Hathaway every minute, or almost $25.87 every single second. With over 500 brands and a presence in 200 plus countries, Coca-Cola offers strong brand recognition and global reach. Now, Coca-Cola is a great company and it's a great brand and pretty much everybody knows what it is, but it's definitely not for everyone as far as investing. Who it's for would be income-focused investors seeking stability, brand strength, and consistent cash flow. But who might avoid this one would be investors hunting for high growth, or those concerned about environmental or social governance and regulatory pressures. Coca-Cola is in the consumer staples sector. It has a dividend yield around 3%. It's had 63 years of dividend increases. The payout ratio is around 75%. And why Coca-Cola is safe is that this is one of the most reliable dividend stocks in history. There's high brand loyalty, global distribution, and consistent cash flow. Now just remember, Warren Buffett bought this a long time ago, and at that point it was a great value to be buying that. At this point, Coca-Cola's value is about on par for what it actually gives. And so unless you're looking for that dividend itself, you're not going to get as good of a deal as Warren Buffett got back in the day, but you are going to get a company and a brand that is super well known, and it's not going away anytime soon. Number 6, I put this one 6th on the list, but it's definitely not 6th on my list in general. This wasn't in any particular order. This one is actually one of the top stocks in my portfolio. And it's consistently been one of the only things to beat the S&P 500 over any period of time, like here you can see over a 20-year period. And this is Berkshire Hathaway. Now, instead of being like all the other ones that I just talked about, Berkshire doesn't actually pay out any of a dividend. It reinvests its profit into high-quality assets. It's really like owning a diversified fund with ultra-conservative management. This one's just so stable and so reliable, it's one of the ones that I've been adding to the most over this past year. So Berkshire Hathaway along with Microsoft are definitely the top stocks that I have in my portfolio overall, and I actually made a video about Berkshire Hathaway specifically. I have that video here, and everyone always asks, well, what happens when Warren Buffett leaves Berkshire? Well, that's happening at the end of this year, so I break it down in this video. And there's a reason why I'm investing heavy in it right now. Or watch this video to keep you going strong in your investing journey, and remember to keep investing simplified.